Hello and welcome to Next NEP. NEP stands for Nonprofit Auditor Points, and I'm your Irina Orishkova, auditor. I created these NEPs to talk to nonprofit community, its management, board, and finance team, hopefully to provide some guidance and answer some questions that are critical to financial health of nonprofits. Hopefully you will find this information useful. Okay, let's talk. Today, I want to talk about FDIC. FDIC insurance. FDIC stands for Federal Deposit Insurance Corporation. All financial institutions in United States of America do provide insurance for the cash deposits to be insured up to $250,000 per entity, per financial institution. So if nonprofit has 10 accounts with the Bank of America, it does not mean that every account is insured up to $250,000. It means that cumulatively, the Bank of America provides insurance up to $250,000 for all deposits. Very often when we perform audit services, we see that nonprofits keep a large amount of deposits with one financial institutions in a regular checking account or savings account, and those accounts are only insured up to $250,000. As auditors, what we do, we always advise them to find some vehicles to ensure that cash deposits have a better insurance and better security than just be $250,000 insured. Most nonprofits do understand the risk associated with losing cash because that's their main asset. However, we all feel that we live in a relatively secure financial environment, and it's very rare when nonprofits lose their funds because bank collapses. However, in our recent history, we've seen the collapse of some financial institutions, and some of our nonprofits did lose some funds because of that not smart investment policies that those financial institutions conducted. Therefore, nonprofits primarily operate not on their own money, but on the money of taxpayers and donors. Thus, it's very critical for the organizations, for nonprofits, entities to have a system of procedures to secure their funds, to make sure that they do not accumulate all their cash in one place, and even if it's not at risk to lose all these funds, if something happens to financial institutions where nonprofits hold their bank deposits, cash deposits, nonprofits might be completely they have no access to their cash. Therefore, it's very good practice to have a policy and procedure that allow to nonprofits to keep funds in the various financial institutions, to spread the risk between various investments, various financial institutions, so at least the organization will have sufficient funds to keep going operations until the issue is resolved. Again, FDIC, which is the federal government, does provides insurance for each investment with each financial institution's cash deposits for up to $250,000. So unless your nonprofit really need to have large amount of operational cash, but even then, we highly recommend to develop procedure where nonprofit can either spread the cash between various financial institutions or develop some methodology to spread funds within one financial institution but invest maybe in CDs of other financial institutions. There is various mechanisms available to increase FDIC insurance, and you as a nonprofit need to talk to your banker how to make sure that we decrease the risk of losing deposits and increase possibility of our funds to be insured. And nonprofits do need to have their policy to understand how much cash they do need to have available on hand, available for operating activity within next month, 3 months, and how much money they can put aside. Some investment institutions, they do not provide FDIC insurance, but they do provide other type of insurances. And your board and your management need to assess if this insurance is a good vehicle for them to use to protect the funds and give their donors peace of mind and security to say, we do understand our fiscal responsibility, we understand how to protect our investments and our cash deposits, and we develop this policy. Very often, nonprofits can invest in a certificate of deposits that they mature in time. So you can invest the CDs that mature in 3 months, 9 months, 12 months. So as a CD maturing, a nonprofit can get more rate of return by investment in certificate of deposits, but also there is liquidity available, because if you know a 3-month CD will mature in 3 months and you will have available cash, then you have another CD 6 months, again, even hopefully better rate of return, not a rate of interest rate, and then 9 months and so forth. And if you do want to build a reserve, you can invest in CDs that mature for the longer period of time. Nonprofits can also talk to financial advisors to see if there is risk, not risky, but some investments that can work for nonprofit. Again, only if nonprofit does not need immediate cash. And also money market funds. Money market funds, they funds that invest in government backed up or very highly rated security, and they do provide good rate of return, but they also provide a good security. To conclude, nonprofits do need to have some policies and procedures to understand their cash management, to see how much cash they need to maintain on hands, and the cash that does not need to be available for operating activities within the next couple of months needs to be securely either invested or saved in some saving accounts or even a cash accounts, but spread between various financial institutions to make sure that the risk is spread. So, and that provides assurance to donors and to management team and to operational folks that nonprofit have sufficient funds that available and properly managed in order for the nonprofit to keep its operation, even if financial market is not safe and something happened on financial market. Hopefully that was useful. Thank you so much for being here with me, and see you next time for the next nap.